On Wednesday, the RBI announced a 35 basis point increase in the repo rate, which now stands at 6.25%, its highest level since February 2019. The rate hike was in line with market expectations though. So far, in the calendar year 2022, the repo rate has been raised by 225 basis points. RBI Governor Shaktikanta Das said that the MPC voted to raise the repo rate to bring elevated inflation back towards its target of 4%. CPI-based inflation has been above the MPC's tolerance range of 2 to 6% for over 10 months. It stood at 6.77% in October and has remained above the target of 4% for 37 straight months. Core inflation stood at around 6% too. The 6-member MPC's decisions were not unanimous though. It voted 5-1 to raise the repo rate and 4-2 to maintain the stance of withdrawing accommodation. The standing deposit facility rate, which represents the floor of the interest rate corridor, is now 35 basis points higher at 6%. At the same time, the marginal standing facility rate, which is the upper band of the interest rate corridor, has been increased by 35 basis points to 6.5%. Even as he said that CPI inflation would likely moderate going ahead, Governor Das emphasized the importance of bringing down core inflation. He called sticky core inflation the main risk at the moment. Core inflation strips away the more volatile components of food and fuel. He added that further calibrated monetary policy action was needed to keep inflation expectations anchored and break the persistence of core inflation. So, what does this indicate for the MPC's future course of action?
See, the RBI has emphasized on core inflation being fairly sticky, and to my mind, it would continue to be so even in the coming months. The reason being that core inflation emanates from the manufacturing and services sector, where companies are still in the process of passing on the higher input costs. So this being the case and inflation still being in the region of above 6%, the RBI per force will have to increase the repo rate once more, probably not by 35 basis points, but by 25 basis points when they meet again in February.
While the MPC retained the inflation forecast for the current year at 6.7%, it made a mild upward revision to the forecasts for the current and next quarters. It retained its inflation target of 5% and 5.4% for the first and second quarters of FY24. The RBI also lowered the GDP forecast for the current financial year to 6.8% from 7% earlier. So, what do the recent MPC decisions and projections mean for the economy and consumption?
So if you look at the purpose of increasing interest rates, it's essentially to curb consumption and investment, because we are trying to slow down the economy to make sure that inflation comes under control. So there's always a delicate balance between making sure that growth doesn't come to a halt, at the same time making sure that inflation comes down. Now, this being the theoretical basis, I think what the RBI is doing will necessarily lead to a slowdown in the growth and credit, which means that both consumption as well as investment are going to be impacted. There's going to be a slowdown in both those two elements. And that's one of the reasons why we are seeing that the GDP forecasts for Q3 and Q4 are in the range of around 4 to 4.5%. So there is a downward, the numbers are not expected to be very buoyant, primarily for the reason that the RBI has taken action in order to curb excess demand pressures, which will result in lower GDP forecasts.
EMIs for home and car loans are also likely to increase. The latest repo rate hike will impact existing and new retail borrowers with floating interest rates. Lenders prefer to extend the loan tenure instead of increasing the EMI when there is a hike in the interest on floating rate home loans. However, according to one report, with the recent hike, extending the home loan tenure may not be available to many. So, what's in store for borrowers?
So let's look at the data. The repo rate has gone up 2.25% in the last 9 months. A 15-year outstanding loan has already added 6 years in tenor. So the option of increasing tenor has almost ended. We're recommending at Bank Bazaar that people should either increase their EMI and keep their tenor what it was prior to this rate hike, or even better, prepay. If you can prepay 5-10% of the principal using your bonus or savings, this is a good time to do it.
Now, how does an increase in the interest rate impacts a new home, loan borrower? It decreases its eligibility. Now, for example, let's say when the home loan rates were at rock bottom somewhere 4 or 5 quarters back when the interest rate started to go up, let's say for an example, for a person of 45 years age with an annual salary of, let's say, 25 to 30 lakhs, his overall loan eligibility would be, let's say, 60 to 65 lakhs, for example. Today, his eligibility would have come down by, 25 to 30%.
And what does the latest rate hike mean for investors?
Fixed deposits are becoming more attractive. Let's look at the data. Repo rate has gone up 1.25%. Fixed deposit rates as of now have gone up approximately 0.5%. They have still room to go up further. The difference between average lending rate and FD rate pre-COVID was 3.86%. Currently, it's 3.56%. So FD rates will go up. There are 24 banks, foreign Indian, private, offering over 7% on the FD. I think consider laddering. Rates will continue to go up on FDs over the next 6 months as the FD rate catches up with the repo rate.
With the external economic environment becoming less favorable, ensuring growth on the back of domestic demand will require a moderation in inflation expectations. Given the persistent and sticky nature of core inflation, the RBI may face challenges in meeting its mandate.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.